Welcome. In this explainer, we're jumping right into the world of investments. And we're going to break down all the core concepts from Chapter 7 of the NISM Series XA syllabus. So whether you're studying for the exam or just want to get a much better handle on your finances, you're in exactly the right place.
All right, here's our roadmap for today. We're going to kick things off with the absolute fundamentals. Then we'll dive into equity, the world of fixed income, check out some real and tangible assets, touch on some specialized investments, and finally wrap up with how you can actually access all of these. Let's get to it.
Okay, first things first. Before we can really get into the weeds of stocks and bonds and all that fun stuff, we've got to build a solid foundation. Let's define what an investment really is and look at its two major classifications. At the highest level, you can really split all investments into two big camps, financial and non-financial. Now, non-financial investments are the things you can literally touch and feel, a building, a bar of gold, maybe a piece of art. Financial investments, on the other hand, they're intangible. They're basically legal claims, just paper or digital entries that give you a right to some future income or value. Think stocks, think bonds.
So with that basic framework in mind, let's jump into probably the most famous type of financial investment, equity. This is where things get really interesting because you stop being a bystander and you actually become a part owner of a business, giving you a real piece of the action.
So what is an equity share? Well, you can think of it as your official ticket to ownership in a company. When you buy a share, you're giving that business capital. You're giving it fuel to grow. And what do you get in return? Well, as a shareholder, you get a claim on the profits, which often get paid out as dividends, and you actually get a say in how the company is run through your voting rights. But hold on, not all shares are created equal. This is a crucial distinction. Equity shareholders are what's known as residual claimants, and that's a fancy way of saying if the company goes belly up, they are the absolute last in line to get paid. I mean last. It's the highest risk position. Preference shares, on the other hand, they get you priority. You jump the line for dividends and for assets if things go south. But for that extra safety, you usually give up your right to vote. It's that classic trade-off, right? Risk versus reward. And it gets even more detailed because preference shares come in different flavors. With cumulative shares, if the company misses a dividend, they still owe it to you. It accumulates. That's a pretty nice safety net. Non-cumulative? Nope. A missed dividend is gone forever. Way riskier. Participating shares give you a chance at extra profits if the company does exceptionally well, and convertible shares, these are really cool. They give you the option to swap them for regular equity shares down the road, so you can get in on the growth if you want. All right, so we've talked about being an owner. Now let's flip the script and talk about being a lender. This brings us to the other massive pillar of the financial markets, the world of fixed income. At its core, a bond is just a fancy IOU. It's really that simple. You, the investor, are lending your money to a government or a corporation. In return, they give you a contract that promises to pay you a fixed amount of interest, that's called the coupon, and then at the very end, they promise to give you your original loan amount back. Now, in the world of debt, who you're lending to is everything. Government bonds, or GSECs, are backed by the government, which, let's be honest, can always raise taxes to pay its bills. That's why they're seen as pretty much risk-free. Corporate bonds, though, they always carry what's called default risk, the very real chance that the company could run into trouble and not be able to pay you back. So, to get you to take that risk, they have to offer a higher interest rate. And that extra interest, that little bit of juice you get for taking on more risk, that has a name. It's called the credit spread. It's your reward for taking a chance on a company instead of the super safe government. You can honestly think of the credit spread as the market's real-time mood ring. When people are scared, spreads get wider. When everyone's feeling confident, they tighten up. So you're probably wondering, how do you know how risky a bond is? Well, that's where credit rating agencies come into play. They act like judges, grading the bonds on a scale. As you can see here, anything from the tippy-top AAA all the way down to BBB is considered investment grade. These are generally your stable, financially healthy companies that are very, very likely to pay you back. Okay, so that was the safe stuff. Now, let's look at the other side of the coin. Anything rated BB or lower gets a different name, high yield, or as most people call them, junk bonds. Don't let the name fool you though. These are the high-risk, high-reward plays. They offer those much juicier yields for one simple reason: there's a much higher chance the issuer could default. We've spent a lot of time on financial paper and digital promises. Now, let's get our hands dirty and talk about investments you can actually see and touch.
Commodities are basically the raw ingredients that make our world go round. They're usually split into two categories: soft commodities, which are things we grow, think wheat, coffee, sugar, and hard commodities, which are things we pull out of the ground, like gold, crude oil, and copper. And then there's the classic tangible asset, real estate. It's powerful because it can do a few things at once. It can give you a steady stream of rental income, it can grow in value over time, and it's often a great hedge against inflation. And hey, if you don't want the hassle of being a landlord, you can invest in real estate investment trusts, or REITs. Just think of them as a mutual fund, but for properties.
Okay, we've covered the meat and potatoes. Are you ready to check out the more exotic side of the investing menu? Let's look at some of the more advanced and alternative options that are out there.
Now, these are definitely not your everyday beginner-friendly investments. Structured products, for example, are custom-built financial tools, kind of like a combo meal of a bond and a derivative to get a very specific result. Then you have distressed securities. This is for investors who love a good comeback story. You're basically buying the debt of a bankrupt company, betting it will turn things around. And of course, there are things like fine art and collectibles, a whole different world. So we've talked about what to invest in, we have all these options, but how do you actually do it? This brings us to the final piece of our puzzle, the channels you use to invest. You really have two fundamental choices here. You can go it alone, the DIY approach, and buy investments directly yourself, or you can join forces with other investors in a professionally managed fund, which is basically like hiring an expert to do the heavy lifting for you. And even in that managed world, there are different levels. Mutual funds are the most common starting point. They're super accessible. But for folks with more to invest, there are more exclusive options, like alternative investment funds. Or you could even hire your own dedicated portfolio manager for a totally personalized strategy. What's really so incredible about all this is how the modern financial system has opened up investing to almost everyone. It doesn't matter if you're just starting out with a little bit of money or you're a seasoned pro managing millions, there's a path for you to participate. So let's do a super quick wrap up. We learned that investments are either physical things you can touch or financial claims on paper. Remember, equity makes you an owner, fixed income makes you a lender. We saw how credit ratings are like a report card for risk. And finally, we know that you can access all these things either by yourself or through a managed fund. So you now have the toolbox. You know what's available. You know what the tools are for. The real question is, how are you going to use them to build something that works for you and your goals? And that, my friends, is where the real art of investing begins.